So let's paint the picture so we can actually figure out what we think is going to go on with interest rates in the bond market. So the first thing we got today is we got continued jobless claims and initial claims. These came on right on point. If you look at initial jobless claims, last reading was 217. They thought it would jack up to 218. It actually dropped down to 215,000. So that means people who lost jobs at a slower pace right now than it was last week. Continued claims is still showing over 1.8 million, but it's actually lower than expected as well. So if you look at the jobs report, it's looking pretty darn good. If you look at the GDP, looking pretty darn good. It's that pesky inflation that we're looking at. So if you really focus in on oil right now, and that's what we usually do when we look at the markets, that's going to predicate where everything goes from here. So let's get over to see where the stock market is today, and especially oil. So the markets right now, the Dow Jones is up 84 points, the S&P is up 18 points, and the NASDAQ is skyrocketing at 262 points. These might be at all record highs again. So let's get over to see what oil's doing, because this is what's going to tell us where inflation's going. Oil is up once again. But the good news is, here's what happened with oil over the last 3-4 months. Pre-war, oil was at $60 a barrel. Mortgage rates were at $5.99. Then oil spiked to $120 a barrel. Interest rates on mortgages went up, and almost to 7%. Then all of a sudden we had a complete reversal in oil. Now we're back down to, well, just yesterday we were down below $70 a barrel. So that's going to bring down inflation, but how long is this going to last?